We're here this morning for our Autumn Budget 2024 webinar, looking at how it affects you and what it means for the media sector. My name's Esther Carder and I'm a partner in our West End media office. So lots of familiar names on the delegate list today. Some of you, I'm sure, know us very well. There might be some of you who don't know us quite so well. So for those of you who don't, MKS is a top 10 audit, tax and advisory firm, and we work with entrepreneurial businesses across all different sectors, as well as not-for-profit and private clients. And in our media office, we have 10 partners specialising in media businesses, and 3 of those have recently joined us after our acquisition of Shipley's, and Shipley's had a very heavy presence in the film and TV sector, so very excited to have those on board as well. And we also have a media specialist M&A team that's headed up by Paul Winterflood, who you'll hear from in a moment. And they've completed over 50 media deals over the last 4 years. So delighted this morning that we'll be listening to Paul Winterflood, our M&A partner, giving us a bit of an overview of the fiscal, political and M&A market. Mel Reed, one of our M&A tax partners, we'll be talking about the tax impact on transactions, and Leigh Collins and Chris Buckden, one of our tax partners and directors, will be sort of covering all the other bits and pieces on personal tax, employment tax, corporate and business tax. So please do ask questions. This webinar is for you. If you've got questions, please ask them, pop them in the Q&A function. I'll keep track of them. We'll either give you a written response, or if I think it's something that's relevant to everybody, then I'll pose it to our speakers. Please do fill the feedback form out at the end of the seminar. It's super useful for us shaping future webinars. And this session is being recorded, so please do share this recording with any peers who haven't been able to make it this morning. So I will hand over to Paul. Thank you very much.
Morning, everyone, and thank you, Esther. Thank you, Esther. Hopefully that echo is now gone. Great. So I'll start off with giving a bit of a background to the budget from a fiscal, political, and M&A perspective. So, firstly, from a political perspective, for those of you that have just ignored the news or been living under a rock, here's what's been happening over the last few months. So, obviously, Labour won a large majority in the House of Commons. More importantly, from a budget perspective, obviously the Chancellor was severely restricted in terms of the manifesto pledges around which taxes wouldn't be increased, and we had quite an unprecedentedly long run up from election to the budget, compared to previous political cycles. And for followers of the Vested Politics podcast, I think the Rory Stewart and Alistair Campbell linked that to the surprisingly early calling of the election. So we had a long time with quite significant speculation over about a four-month period. So what we saw, so if you go to the next slide, please. So in the run up to the 30th of October, we had scene setting over the summer. Very much the Labour government seeding and setting the scene for a painful budget, and very much laying the ground for tax rises. Then what we saw over sort of more recent weeks and certainly post summer was more rampant speculation of which taxes would go up, and various leaks as the Treasury and government tried to work out where to politically set the landscape, and in particular that was around the remaining taxes, which could change, which was capital gains tax, inheritance tax, employers' NICs, and pensions tax. And then in more recent weeks, there was a discussion about what are working people. Over that time, it's been, I think, in 2024, it's been quite a tough period for media businesses. Very much so in the TV space, and I think on the marketing services landscape as well. And it's taken taken time for client spend to return, and certainly has been. I think the year has been a lot tougher than hoped. Then, from an M&A perspective, which was very much linked to one of the taxes which expected to go up, we saw a large amount of speculation about the potential impact of CGT increases. So, if we could skip to the next slide, please. That absolutely had a significant impact on the M&A market, and there were certainly predictions of at the worst case equalization of capital taxes and income tax rates, and that very much incentivized people to get deals done. That speculation ramped up over the summer. In previous years, the budget and the rumours of tax changes often were culminating in March, and that included when the previous government slashed the Entrepreneurs Relief BADR threshold from £10 million down to £1 million. And it's pretty common to see people trying to drive deals to complete before the budget day and before any tax changes. And we ourselves closed 5 deals on the 29th of October. There were numerous deals in the media space, but I think for a lot of businesses, and I think for those of you that joined our M&A webinar a month ago, it was quite early in the cycle. The M&A market was quite was definitely tougher at the moment, reflecting the tougher media landscape, and so it was quite difficult for a number of businesses that weren't already at offer stage to accelerate processes. We did see a number of opportunistic bids from buyers. Thankfully, I'd say with the clients that we were advising, ultimately they decided not to proceed with them. And I think with the benefit of hindsight, that was definitely the right decision for them. And I'll hand over to Mel, who's going to talk through the changes in more detail.
Thanks, Paul, and good morning, everybody. Nice to meet you. So what were the changes that were announced in the budget last week? So I think, as Paul mentioned, there was a lot of fear around how bad can it be? How high are capital gains tax rates going to be? And is there a possibility that they will align with income tax rates? Well, I think it was a lot better than feared. And I think for most of our clients, particularly on the businesses we sell, there's been an increase in the rate of capital gains tax from budget day from 20% to 24%. If you're not a high rate taxpayer, the rates you pay capital gains tax at the lower rates, and that's gone up from 10 to 18% from 30th of October being budget day. There was lots of fear about what was going to happen with business asset disposal relief. I was very much a firm believer that there would be something maintained for business owners. It would be very anti-business to take tax relief away from entrepreneurs. And so the £1 million lifetime allowance has been confirmed as remaining in existence. So what that means is your first £1 million of lifetime gains will continue to be taxed at 10% until the 6th of April, when the first million will then be taxed at 14%. And then from April 26, they'll be taxed at 18%. Once your gains are over £1 million, you will then be paying capital gains tax on the excess at 24%. So what does that look like in practice? So if we take a company that, I mean, you pay tax on not on the proceeds, on the gain, but let's say for simplicity, we've got proceeds of 10 million, which is equal to the gain, and we've got 4 shareholders. That wouldn't be an abnormal transaction for the type of transactions that Paul and I regularly work on. So if you had have completed your transaction, if you were one of the 5 that we completed on before budget day, you would have, on your gain of 2.5 million, ended up, after paying tax, your first £1 million is taxed under business asset disposal relief. So you pay £100,000 there. And then your capital gains tax is 300,000 on the excess. So you end up with net proceeds of 2.1 million. From budget day, that immediately goes up because the excess is taxed at 24%. And then from April 25 and April 26, that's when you have then the increase in the 10% tax rate to 14% and 18%. So I think, you know, probably the takeaway message I would leave here is that, you know, if you're selling today in that scenario where you've got 2.5 million of gain, compared to in April 26, then you're going to be paying £80,000 less capital gains tax now than you would if you sell after April 26. I think it's probably, you know, the tax tail shouldn't wag the dog on this. You know, when you look at actually the net proceeds, yes, they're higher, or sorry, the proceeds are less because the tax liability is higher. But I think it's certainly a better position than we all expected it to be. So moving on to EOTs. So these are employee ownership trusts, and I guess the reason they sort of sit in the tax transaction update is they're quite often used by entrepreneurs where maybe a trade sale or a sale to private equity or an MBO might not be right for whatever reason, and they have been very popular over the last few years. There's been a consultation over the last year as to should the tax relief remain for employee ownership trusts in the same form that it has been for a number of years. There's some tightening up in terms of who can actually control the employee ownership trust, so the trust that owns and makes the decisions for the company. And it's now been clarified that former owners cannot continue to control the EOT through being trustees collectively, whereas before it was a possibility. I think the other thing just to bear in mind is we have done transactions in the past where, let's say, founders want to do a partial exit. They would sell 51% of the business to an EOT with a view to growing it over the next year or two, and then doing a secondary transaction, selling the other 49% to a third party later on. Provided you left a full tax year between the sale to the EOT and then a secondary sale, so out of the EOT, including the remaining 49%, then the initial gain was free of capital gains tax. That was 1 year. That has now increased from budget day to 4 years. So anybody considering use of employee ownership trusts effectively as a stepping stone to an onward sale whilst they look to grow the business, there's now a considerably longer time that you need to factor into your decision making there. So that's it from me. I'm just going to head back to Paul to sort of, I guess, just give a view on where that leaves us.
Yeah, thanks, Mel. So from a post-budget M&A perspective, we're now in a situation where there's certainty about the tax environment for the next few years, which is definitely a positive. We're now in a situation where we know what the tax position is going to look like. So we can very much now resume conversations with clients around what the options are, and it's far more market driven, which is a lot more important. Also positively, Mel mentioned about the taxes. Tax changes weren't as painful as potentially feared. So I think the advice now is go to market when it's right for your business, and definitely rather than when it's right to go from a tax perspective. And I think that leads to better outcomes all round. We concluded our M&A report last month saying that a combination of a continued economic recovery, reduction in interest rates, and a budget that is favourable to entrepreneurs would put the M&A market in a much stronger footing going into 2025. I think it's probably, I think the budget is probably middle of the road from that perspective. I think what is going to be key is what the impact is going to be from a growth perspective, both in terms of the whole economy, the media market as a whole, and then for individual businesses. Success in the market ultimately comes down to growth being generated, and for businesses that are growing, there's always a market for deals. There's a but still, and that's very much in the employer national insurance contributions column, which Chris will be discussing more on shortly. that's definitely going to have an impact on valuation, as everybody's P&L will need to be normalised going forward for the higher cost, and that's clearly going to have a big impact for media businesses, making the growth far more important. I think my final thing is probably just around I'm sure it is what's going on across the pond today, and the US election. I think subject to the results of that, we're starting to see a stronger media landscape very much in the US. Hopefully there's stability coming out of the US after today, which will definitely, I think, put the whole market in a better position if that does come to pass. That's it from me from an M&A perspective. I'll now hand over to Leigh, who's going to talk through the changes from a personal tax perspective.
Thank you, Paul. Next slide, please. Okay, from a personal tax perspective, Paul and Mel eloquently covered capital gains tax. So I'll provide you with a roundup of all the other taxes that may impact you moving forwards. From an income tax perspective, as we've already said, the manifesto pledge did provide some restrictions for no changes in income tax. And as we now know, employee national insurance rates as well. More to come from Chris on the employer national insurance situation as it stands. The main income tax rates and thresholds will also remain frozen until April 2028. There's a lot of talk of a fiscal drag, so effectively what that ultimately means is that the allowances and thresholds will remain low, whilst hopefully everyone's salary increases, obviously pushing people into a slightly higher tax rate potentially there, and from a national insurance perspective too. One thorn in the side, which hopefully will be addressed now, is the high income child benefit charges, which are recouped if you have an annual income in your household of over £60,000. The way they're trying to look at this, then there was talk about effectively saying, well, we're going to give individual household assessments, but that from an administrative perspective is proving far too costly. So what they are going to do now is either automatically put it in your PAYE code if you have a salary based on your P60 salary, or indeed it will be pre-populated on your self-assessment tax return, because it's one of the things that's often overlooked and can lead to inquiries and questions from HMRC. Moving on to the much talked about non-UK domicile regime. From the 5th of April next year, the concept of domicile will be abolished in its entirety. So this is quite a major shift if you are not born in the UK and or lived here for a long period of time. And this is going to be replaced by a 4-year foreign income and gains regime, FIG for short. There are quite a few acronyms on through our presentation, to basically provide easement from a domicile regime over to a residence-based regime moving forwards. The new transitional regime is available to anyone who has not been UK resident in the previous 10 years. The current remittance basis paid by some taxpayers who are temporary resident in the UK will also be rebased, so that your foreign assets are being rebased at their value of 2017, and any remittance pre 6th of April next year can be used during a facility to move things into the UK should you wish to. Now, this is far too complex to cover in a slide, and HMRC are going to issue some more guidance in relation to this. But basically, to summarise, if you are not domiciled in the UK but lived here for a short or long period of time, we are effectively moving from just taxing what you earn and sell in the UK to a worldwide basis of taxation, rather similar to the US and other jurisdictions. Obviously, there will be treaty relief if you pay taxes on a US asset, similarly as you would do if you had a UK property but was a US citizen and was taxed there. So it's just a fundamental shift to worldwide taxation of individuals ultimately. There are some helpful things that are going to be retained and reformed. Overseas workday relief. So if you work in the UK and work overseas too, then there's going to be some easement on that. There's also a consultation taking place in relation to offshore anti-avoidance with a view to simplification. Now, just saying that sentence in itself is quite a tongue twister. So there is talk they want to stop people moving assets or income overshore to tax advantage areas, but how they're going to police that and legislate against it is quite cumbersome. So conversations and consultations have started in relation to that for now. Moving on to inheritance tax, which obviously will affect us all at some point in time. The nil rate bands are remaining the same and have been the same for quite some time. We're currently looking at April 2030 before they are looking to be reconsidered. Everyone has a single nil rate band in the UK of 325,000. There's also an additional 175,000 in relation to your private residence, your home, which is effectively £500,000 per person until you get to a £2 million mark, where that is tapered down. So the headline act that people see is that if you are a couple, you own your own home, you have effectively that house can be worth up to £1 million before your children pay any tax on the inheritance of that property. So that fundamental exemption is still there, we're pleased to say. There are some changes though in relation to pension funds and death benefits, which were previously not taxable within your estate. From April 2027, any unused pension funds or death benefits of the deceased person will be subject to the normal inheritance tax rates, unfortunately. And at this point, it's also probably good to mention that there was talk about restricting pension relief for income tax, and that hasn't been touched at this point in time. So that is good news in certainly in its singularity. Okay, inheritance tax, as we said, will be based, like income tax, on long-term UK residents rather than domicile now. And individuals who's long-term resident and in scope for inheritance tax on their non-UK assets when they're resident for 10 out of the last 20 years. Excuse me. So effectively, to summarise the changes, if you are been resident in the UK the last 10 of 20 years, you will now be subject to inheritance tax on your worldwide assets, obviously with first taxing rights in overseas jurisdictions. And of
Leigh,
course,
just to interject there, somebody's asked a question. They've asked about inheritance tax on second home, and is the value added to that of the first?
The second home is not, certainly, thank you for that. The value of the second home is subject to normal inheritance tax within your estate, so the 40%. If you have £1 million home as an example and a £500 buy-to-let property, then effectively the £1 million will only be allowable in relation to your private residence, and it must be passed on to your children. Whereas a buy-to-let, if you have no other assets, it will be allowable within the 325k per person. And if it's jointly owned between spouses, then that's passed on and doubled up effectively. But the 175 will not be available on a second property or a buy-to-let. It's purely on your PPR, your main home, if that answers the question, hopefully.
Thanks, Leigh.
Thank you. And as I was saying, anti-avoidance remains in scope. People often with residency, they try to plan forwards. Excuse me. And that is certainly something we can certainly help you with. It's certainly not off the table, but there are far more anti-avoidance regimes coming into force now. So if you were resident for 10 of the last 20 years for inheritance tax, you will remain in the scope of inheritance tax in the UK if you left the UK for 3 to 10 years. So to summarise that point, you would need to leave the UK for 10 years in order to be completely free of the UK inheritance tax regime.
Leigh, just building on that first question about second homes, they've asked if the second home is abroad, does that again fall into IHT? I'm assuming it does.
Yes, it does now, and that's a fundamental change. Well, the UK have basically gone from like many other jurisdictions, including the US, to taxing what's cited in the UK for non-domiciles to what's basically anywhere in the world. So it would certainly come into the IHT regime in the UK, but obviously minus any reliefs available from overseas jurisdictions potentially.
Thanks.
Excuse me. Just some other IHT roundups. Excuse me, I'm one of those people with a very annoying cough at the moment. There are changes in relation to, we haven't mentioned it here, but if anyone has a farm, agricultural property relief has sadly gone now. And in relation to business property relief from 2026, there will be still 100% on the first £1 million, but after that it will be reduced to a 50% relief. Now, for owner managed businesses, this is a real kick in the teeth to a certain extent, because if your business is worth more than £1 million, excuse me, then effectively, if you've got a £5 million business, then the extra million, the 4 million, will be subject to IHT at 50% at the moment. Now, this may cause a problem where there's not other cash in the estate to pay for this. You may have to sell the business. You may have to refinance to pay for this, but it's certainly something, excuse me, if you're not looking to sell and it's a family business that will be inherited, then please contact us, because we can help you plan forwards to that and make sure you have the right funds in place to cover that. And also, equally valid point, if you're an investor on the AIM market, which are not up and coming, not listed securities, then again, there's only 50% relief for that. But with that, you can cash them in and provide more available funds to pay the IHT. It's the family business element and the business property relief which is going to cause a problem, and we can certainly help you plan forwards for that if you're looking to generationally pass on your business to your family or elsewhere. There are lifetime things we can also do for that. I digress, but as an aside, like gifting shares, certainly things that can be done to move and flex with the new legislation there. Also moving on to stamp duty, which is another thorn in the side, unfortunately. But as you mentioned, with second homes and inheritance tax previously, it's certainly something worth mentioning. Immediately, the rate of additional dwellings, i.e. any form of second property in the UK, and this is only UK property, it's restricted to UK cited residential property in that respect, will go from 3 to 5%. So that's a sunk cost that needs to be taken into consideration at the start. It may affect the property value, we shall see, but that's certainly a cost that needs to be accounted for. Stamp duty, land tax, the equivalent for companies and trusts who acquire residential property of more than £500,000, excuse me, will increase from 15 to 17% immediately. There was a manifesto pledge to increase surcharge on non-residents acquiring residential property in the UK. up to 3% from 2%. But that wasn't mentioned in the budget, so it may be in the back pocket for later. And the temporary uplifts that are available at the moment for first-time buyers and lower property values will expire in April next year. Just to recap, first-time buyers have no stamp duty payable on the first 425,000 for homes costing up to 625k, and these figures will revert respectively to 300 and 500 from next April. So if you do have any, if you are yourself a first-time buyer, if your children are, then we expect that the market, and they're lucky enough to have something that's over 300 grand but less than 45, then the market will be pretty brisk in relation to that to get that sorted by next April. And just for non-first-time buyers, the zero rate for stamp duty is going to decrease by 50% to 125k from the same date of April 25. So conveyancers will be quite busy for a while, I would think. Finally, before I hand over to Chris for employment and corporate and business tax, so just a few other roundup matters. If you have a furnished holiday let, then the additional rules in relation to that will be abolished again next April. That's just basically in relation to capital allowances, loss offsets, that kind of thing. They will be treated exactly the same as investment property as a buy-to-let from next tax year. And last but not least, always worth a mention, individual savings accounts, ISAs, main subscription limits are all in force until 2030. And the main headline is the 20k for ISAs. That's the main type of investment vehicle for that purpose. So over to Chris. Thank you.
Good morning, and apologies in advance for blighting your mornings with elaboration on the Employers National Insurance tax raid. That's been well publicised, and as we acknowledged in our media sector specific budget reaction LinkedIn post, these changes will be particularly keenly felt in the media sector, where we're dealing with people, businesses for whom wage costs are proportionately higher than, say, in a manufacturing business. So the Employers National Insurance contribution rate is increasing to 15% from April next year, and the point at which employers are liable to start paying national insurance is falling to £5,000 per employee. Now, to offset some of the impact of that on small businesses, the employment allowance, which is a per business allowance, will be increasing to £10,500, and the £100,000 eligibility thresholds being removed so that all businesses can potentially benefit from that. And you'll see we've got an illustration there that shows that per employee earning £35,000 a year, this is expected to increase the national insurance cost by just under £1,000 per year. Something I would note is that these changes aren't just going to impact your more wages and your more obvious benefit in kind. They could equally apply in some circumstances where an employee perhaps acquires shares in the business at undervalue. The undervalue amount could be subject to employment tax and include a cost to the employer there through national insurance. But there's various ways we can help with this. You won't be surprised to know whether it's comparing remuneration strategies where paying dividends is an option, doing calculations that take into account factors such as timing of liabilities and trade-off with pension contributions. I think it's fair to say making maximum use of salary sacrifice arrangements is going to be important. And over time, we may see more use of freelancers and overseas talent as a result of these changes, which are, of course, well-trodden paths for companies in the sector. There are tax considerations to navigate in either scenario. In the case of freelancers, you have the question, are they really self-employed or to be treated as employed for tax purposes, and potential application of the off-payroll working rules. And the complexities that apply when you're dipping into the international talent market are increasingly becoming relevant with existing UK workers we're seeing who are wanting to do agile work from abroad or perhaps even relocate to a lower tax country. Now, the minimum wage increases are, there's a correlation with national insurance here, because even if you don't have employees on these minimum wages, they're consuming goods and services that are provided in part by people on these minimum wages. So the inflationary impact of these will feed through into wage demands by your staff, and therefore national insurance costs for you. If we could just go on to the next slide. Other employment tax measures, there was a confirmation of a previous announcement that there'll be mandatory payrolling of benefits in kind from April 2026. This country currently it's possible to do this voluntarily. This won't apply initially to living accommodation and employee loans. But I think the key takeaway here is that employers need to start assessing their benefits and expenses and considering how the current process could be impacted by these measures. And I wouldn't be surprised if we see some firms doing voluntary payrolling of their benefits from this April to allow time to become familiar with the process before it becomes mandatory. Also, from April 2026, recruitment agencies are going to be responsible for accounting for PAYE on payments made to workers supplied through umbrella companies. And this is aimed at what is perceived to be quite widespread tax avoidance and fraud using umbrella companies, but potentially of relevance to people on this call. If there's no recruitment agent involved, the responsibility will shift to the end client business. And if we go forward onto corporate and business tax now. So fortunately, I think there's been a recognition by the Labour government that stability and certainty are key to encouraging the investment that fuels productivity and growth. And this corporation tax roadmap that's published alongside the budget provides comfort on the availability of key allowances and incentives across the remainder of this Parliament. So there's picking up some of the points in there. Corporation tax remains, the headline rate remains capped at 25%. I'd say that the threshold for the small profits rate does remain low by historical standards. So it's a shame we didn't see any movement in that. The existing suite of capital allowances has been maintained, and there's the full expensing regime is quite generous, so that's good news. The existing R&D reliefs and the planned merger of the regimes has been retained, but I think there's now going to be a focus on developing and improving the administration of those tax reliefs. And it's probably fair to say that recent changes had undermined investor confidence in R&D reliefs to an extent. So the stability now should be welcome news, as will be expansion of scope for getting advanced clearances on those relief claims. There are proposed reforms to transfer pricing that will include potentially removal of UK to UK transfer pricing requirements, but also the exemption that applies to medium-sized businesses will possibly go, so it will just be small businesses that are exempt from UK transfer pricing requirements. So that's companies with less than 50 employees and turnover or balance sheet of under 10 million euros. It's probably fair to say that where people do have international interaction, a lot of businesses were eligible for the small and medium-sized companies exemption, but it's in the other territory that they were facing more scrutiny in terms of their transfer pricing. So that might not make a big practical difference to people. There is a running theme of stability in this corporation tax roadmap. They appear to be endorsing the existing structure of corporate taxation. And most of the changes are in niche areas. They had originally promised a business tax roadmap, so it's disappointing that the scope's been narrowed down to corporation tax, as unincorporated businesses would benefit equally from the improved certainty we're seeing here. And of course, the US election results are likely to be relevant. If the US corporation tax rate rises to above the UK rate, and 28% has been proposed by the Democrats, the scope then for transatlantic tax planning, or more scope for it. There's potential for changes to what's called the global intangible low taxed income regime. So I'd say transatlantic tax health check by us is more likely than ever to be beneficial. And if we could just come over onto the business rates slide. So there's been a manifesto pledged for full reform of business rates, and a discussion paper has been published to look to address that. But there's some interim measures here aimed specifically at the retail, hospitality and leisure sector. There are some relief there and a capping of rates payable in that sector. If we can come over to other measures, that this is one will be of interest to people on this call. So the change to audiovisual expenditure credits, this measure was previously announced in the spring budget this year, but will now be legislated. And following consultation on the types of expenditure to be covered by this additional tax relief for visual effects, it's been confirmed that from April next year, film and high-end TV productions will be able to get an enhanced 35% rate of AVEC on their UK visual effects costs. This brings it in line with the rate of AVEC which applies to animation and children's TV. UK visual effects costs will be exempt from the 80% cap on qualifying expenditure, and costs incurred from the 1st of January next year will be eligible. And I would say that the fact that the 80% cap on qualifying expenditure is now being removed in one specific area may give hope that this could lead to a relaxation of the rules in relation to these reliefs more widely. If we just come over onto indirect tax measures. So we'd all heard at length about the changes impacting private schools. They're going ahead. We've got no changes in the rates of VAT more widely or the registration threshold. We've got some changes to the soft drinks industry levy and air passenger duty rate increases. I won't elaborate on them unless anyone's particularly passionate about those. In something of a surprise, fuel duty rates were not increased, been frozen, and the temporary cut maintained. So we're seeing fuel duty remaining at just 53p a litre. There are some changes for first year vehicle excise duty rates for new cars, aimed really at widening the gulf between driving a fully electric car and a hybrid. So there's going to be a tenfold increase in the first year VED rates for most hybrid cars. But we have got some certainty on the percentages that apply and working out the benefit in kind on company cars. So the rates up until April 2028 are unchanged. We know we're then going to have a 1% increase in the 2 following years. So I think what's important there is decisions about company cars based on costing can be made because we know where the rates are going to go on those. And over to Leigh now to talk about HMRC's ever lengthening tentacles.
Do we have you, Leigh? We may have lost Leigh. Mel, do you
I was going to say, do you want me to pick this
yeah,
up?
thanks.
So I think that was a pretty good intro from Chris in terms of HMRC's ever lengthening tentacles on the basis that the powers that they have in terms of their inquiry powers, but also the, I guess, penalty regime, and what it's really doing is almost trying to scare taxpayers into ensuring that they're 100% right in terms of their tax submissions. So we have, as we've had for 20 years or so, a system of self-assessment for both companies and individuals. And what that really does is put the onus on taxpayers to have to make sure their tax affairs are correct. If they're not, then HMRC have numerous powers to obviously inquire into the tax returns, And the penalty regime that comes with this, and it's covered here, is about the behaviour of taxpayers. So what HMRC really take a dislike to is taxpayers that haven't taken advice, have winged it, haven't really actually sort of done their due diligence on the proper filing position. And they see that as being careless, and the behaviour associated with that means a higher penalty regime. If a taxpayer has taken full advice, they've carefully thought about everything they're doing, they've taken a particular filing position, and they can show that they have taken reasonable care, as HMRC call it, then the penalty regime is much less. So part of what we've heard in the budget this week is that HMRC are consulting on having an even higher powers and penalty regime. And where this would kick in is let's say you're a business, you find something in last year's tax return that maybe not have been quite right. There will now be, based on the consultation, a obligation to disclose that to HMRC, as there is now. But if you do not do that, there's potentially 100% penalty based on the lost tax. So it's really trying to ramp up and put the onus on taxpayers to make disclosures where they find errors, rather than waiting for HMRC to come knocking. I think it's probably fair to say that over recent years, well, again, certainly the last 10 years, maybe paying tax a little bit late was seen as probably a bit of a cheap way of borrowing from HMRC. And, you know, whilst it was never recommended, lots of people have done it over the years. And HMRC are really taking offence to it now. So what used to be quite low interest rates in respect of late paid interest are really ramping up. So from April 2025, interest on late paid tax is increasing to 9%. So it's really trying to get taxpayers again to scare them into compliance and make sure that everybody pays their tax on time. With this, if we can just go on to the next slide, please. With this, I guess HMRC are hoping there's going to be lots more disclosures. So they're investing to recruit a lot of compliance people to deal with these disclosures, but also to investigate a lot of the offshore and non-compliance that goes around. So they're talking about an additional 5,000 compliance staff. I know certainly from our side of the fence, we would appreciate HMRC to have more people that we can talk to. I don't know, I'm sure most of you on this call have had to try and contact HMRC at some point over the last year, and you just lose hours of your life on the phone to them. So I think in some ways that should be a positive thing for people that actually do just want to speak to HMRC and get some advice or talk to them about you know, reallocation of tax payments or whatever it may be. So, but will we see any improved levels of service from HMRC? I guess we will have to wait and see. And obviously collecting in tax debt is a key area of focus for HMRC. At the moment, the inheritance tax regime in terms of filing inheritance tax returns is quite clunky. It's typically done by executors of the estates, and there's lots of different forms to fill in. HMRC, again, aren't great at dealing with post. So I think the digitalisation of inheritance tax compliance is probably going to be seen as a positive for most people. I think we need to be mindful of the access to digital technology for some of those people that might be looking to file inheritance tax returns, and they're going to need to get some more support on those. And I think the last comment on this is the long-awaited commitment for making tax digital for self-assessment. So this is effectively where you're going to be quarterly reporting to HMRC as an individual. Now, I mean, I can't remember how many years we've talked about this. I want to say 6 or 7 years. The first one that came in was obviously VAT with the RTI links, and that's obviously been in place for a number of years. but there is still a commitment to make tax digital for self-assessment. And what that means is HMRC will have access to your tax information on a real-time basis, such that if if tax payments aren't being made in the July and January, then it's another way of actually being able to do those prods to individuals along the way. And undoubtedly that will tie in with HMRC looking at recruiting more debt management staff. So I think, having just jumped in, I think that's the last slide. So I'll probably hand back to you, Esther.
Thank you very much for stepping in there, Mel. And thanks also to Paul, Leigh and Chris for a nice run through of all the interesting bits and pieces that came out of the budget. And certainly definitely pleased that there was less pain on capital gains tax than we were perhaps expecting. I think that bodes well for the media M&A market in the following years. So thank you all very much for attending. If you do have any questions that occur to you once we've closed the webinar, do get in touch with myself or any of the panelists today, or your usual partner that looks after you. Remember that it was recorded, so please do share with any peers or colleagues who were unable to make today. And another reminder, please, to fill out the feedback form. It shouldn't take very long at all, and it does help us to shape future webinars. So thank you very much, and enjoy the rest of your day. Thank you.